We're a little under a week away from the Fed's September meeting. With that in mind, interest rate traders largely believe the Fed will hold rates steady this month. You can see only 3% of interest rate traders predict a rate hike. But the November meeting is a different story. You can see more of a spread here, 30% of traders pricing in a rate hike. So then what are so-called Fed-spectations across Wall Street? Yahoo Finance's Blikre has those details for us. So Jared, what are we watching here?
Yes, Rochelle. As you point out, not much expected to happen next week in terms of the main rate, maybe in November, but even then it's only a 30% chance. But I want to show expectations of where the Fed's benchmark rate, the Fed funds rate, is going to be based on market participants' actions through the capital markets here, all the way through September of 2027. So this goes basically 4 years into the future. You can see there's a little tick up right here, so maybe the Fed is not done quite yet. Another 25, 50 basis points to go is the thinking there. But then we start turning down. So pricing in rate cuts starting in 2024. I have 3 lines on this chart. The orange line at the bottom is where we were at the end of July, and then the cyan is where we were at the end of August, and the purple one is where we are right about now. And as you can see, we started a couple months ago lower. So expectations have been shifting higher for fewer rate cuts because it only takes fewer rate cuts to get to this higher level right here. So this comes as a result of surprises in the economic data that we're getting that are largely beneficial to the economy, showing strength. And so this means we are seeing good news, means good news for the economy, means good news for stocks and risk markets overall. This is a Citi Economic Surprise Index going all the way back 20 years to 2003. And we can see right here, we are at elevated levels versus history. You can see roughly this resistance line here, and we're a little bit off from that. But by and large, the economy has been not roaring, but has been not sputtering. It's basically been kind of a Goldilocks situation where traders think the Fed doesn't have to act too much, but at the same time, we don't see a recession coming. And all of this just means that if there is another recession coming or something develops that surprises traders to the downside there, we're going to have a big repricing of risk. The last chart here, this is a little bit separate, but this shows bank reserves. That's the purple line, and you can see how this pretty closely tracks the swings that we're seeing, the ebbs and flows in the S&P 500, which is the cyan line. But what you'll notice is the cyan line, the S&P 500, has climbed rather precipitously here over the last couple quarters, where we're seeing bank reserves just a little bit up, maybe flat. So just in terms of correlation, one wonders, is this gap going to be closed? Are reserves, in other words, that's kind of a bank proxy for risk, is that going to catch up to the S&P 500, or will the S&P 500 catch down to reserves? Something I think a trader is going to have questions for Jay Powell next week is the reserve status, quantitative tightening. Where are we with that? We're almost to $8 trillion in bank reserves, not only bank reserves, but the Fed's total balance sheet. That is down from about, $9.5 trillion. That is substantial, and that is a de facto drag on the economy. So I think there are going to be some pointed questions about that, but we'll have to wait and see what happens at 2:30 p.m. on Wednesday for that Powell taking the lectern moment, guys.
Indeed, certainly a lot for the Fed to have to consider before those announcements. Appreciate you, as always, our very own Blikre.